last person to write code, so when we started this episode, I was like, do I even belong here?
Oh, I mean, same.
Welcome to episode 18 of the Joinprop podcast. I'm Ken, head of content at Joinprop, and I guess today I am trying to understand the machines that are basically running the financial world.
And I'm Jessica. I'm a freelance podcaster, and I'm basically here to be the proxy for, you.
Right.
Because if you're listening to this while you're driving or making coffee and you see the word algorithm and immediately just want to close the app, that's me. Because when I looked at the notes, honestly, I was expecting the whole Hollywood hacker thing, like neon green text falling down a black screen in a basement.
Right, the whole Matrix aesthetic.
Which is what everyone pictures. And the more I read, the more I realized it's not really that at all. It's somehow way more boring and way more terrifying at the exact same time.
Yeah, terrifying's a good word for it.
I don't know. I just want to know what this actually looks like inside these prop firms. Because if you're out there looking at YouTube, everybody talks about trading bots. But I feel like 90% of it is just marketing garbage.
Yeah, no, it totally is. Most of what you see on social media is just, it's completely fabricated. But the reality is, and this is the thing that really messed with my head when we were putting this together. Okay, let me back up.
Okay.
Let me just throw this stat at you first, because I had to double check this when I read the source material. Over 70%. 70% of the daily trading volume on the major exchanges right now is just driven by algorithms. It's not humans.
70%. 70, I need a second.
Yeah.
So you're saying if you or I log on right now and look at a chart on our phone, most of what's happening isn't even people.
Not even close. I mean, the market is basically just machines yelling at other machines in like milliseconds. The human element it's shrinking fast.
Okay, that is genuinely uncomfortable. Because you always picture the trading floor. The guys in the fleece vests screaming at each other on the phone, waving pieces of paper, and you're telling me 70% of the money moving around the global economy is just servers talking to servers.
Yeah, the vest guys are basically extinct.
Yeah.
Or, I mean, they're sitting at desks babysitting the code now. So the thing is, when we talk about algo trading, especially in these high-level prop firms, it's not just bots making money. That's the scammy Instagram version. It's actually more like, think of it like an assembly line.
Like a car factory.
Like a highly automated factory, yeah.
Got it.
So you have raw materials coming in, which is the market data, and then it goes straight to the end where, boom, the system just executes the order based on...
Wait. Boom. It executes. You just skip the entire middle of the factory. What happens between the raw material and the boom?
Okay, fair. I always jump to the execution part because the speed is the crazy part. But okay, let me walk it back. So the assembly line. First, data collection. And this isn't just looking at the price of Apple or whatever. It's order flow.
Which is what?
Order flow is basically seeing the line at the cash register before the people actually buy the stuff. Like seeing the pending orders waiting to be filled. So it takes in that. It takes historical data, and sometimes it's even scraping news headlines in real time using natural language processors.
Stop. Natural language processors. You're losing me.
Sorry. It's basically AI that can read human text. So a machine reads a headline that says, Federal Reserve cuts rates, and the code literally understands what those words mean for the economy in a fraction of a second.
So it's reading the news faster than I can even refresh my browser.
Exactly. It takes all that raw data, and then step 2 is signal generation.
Meaning a green light goes off, like, go buy now.
Kind of. It's the algorithm checking the data against hundreds of predefined mathematical conditions. If X happens with the interest rate and Y happens with the order flow, then that's a signal. But it doesn't just buy yet. Then it goes to risk assessment.
Okay, so checking if it's actually a good idea to spend the money.
Right, checking position sizing. Like, the code asks itself, we have the signal, but are we risking too much of the firm's capital on this one trade? Or is the market too volatile right now? And only if it passes all those checks, which takes, fractions of a second, then it goes to execution.
Yeah.
And then post-trade analysis. It's this continuous loop.
Just endlessly looping.
Yeah. And the whole point of this, the reason prop firms spend billions on it, is to completely strip human emotion out of the process.
Okay, I have to push back on that. Because this whole remove the emotion thing, you hear it all the time in finance. But isn't human intuition the whole reason great traders are great? Like having a gut feeling that the market is just off today? Because you can't code a gut feeling. If something weird happens in the world, a human can look at it and say, hold on, let's wait, this feels wrong. A bot is just going to blindly follow its code and probably drive right off a cliff.
See, you say gut feeling, but what you're actually describing, like 99% of the time, it's just cognitive bias.
Oh, come on.
No, seriously. Think about it from the perspective of someone sitting at a screen. When a human trader is having a gut feeling, they're usually just scared because they lost 3 trades in a row yesterday. Or they're getting greedy because they're on a hot streak and they think they're invincible. Humans get tired. They get mad and start revenge trading.
Revenge trading.
Yeah, like the market took my money this morning. I'm going to win it back right now by doubling my bet. An algorithm never gets tired. It never gets mad at the NASDAQ.
Fine, humans are messy, I'm messy, but algorithms can't adapt on the fly the way a person can if the context changes.
They don't need to adapt on the fly if they execute perfectly. Wait, there's this stat in the research. This is wild. There's a trading desk in Chicago, and I'm trying to remember the exact numbers. Uh, okay, they implemented machine learning just to handle the mechanical execution of their trades.
Yeah,
Not even
simply.
picking the trades. The humans were still picking what to buy. The machine just clicked the buttons.
Just clicking the mouse, basically.
Exactly. And they increased their Sharpe ratio by 34% in just 6 months.
Okay, hold on. English. What is a Sharpe ratio?
Yeah.
Because you can't just throw that out there.
Oh, my bad. Sharpe ratio it's a way to measure risk-adjusted return. So it's not just how much money you made, but how much risk you took to make it.
Give me an example.
Okay, say trader A makes $10,000. But to do it, they had to risk $50,000 of their account. They were taking huge, wild swings. Trader B only makes $5,000, but they only risked $100. Trader B has a way better Sharpe ratio because their returns are incredibly efficient relative to the risk. A higher Sharpe ratio means you're getting better returns for the exact amount of risk you're taking.
Okay, so it's a measure of safety and efficiency, basically.
Exactly. And a 34% jump in 6 months is insane in the institutional world. And they did it just by letting machines do the dirty work. Because humans were basically just fumbling the execution, clicking slightly too late, hesitating, second-guessing themselves at the last millisecond. The machine doesn't hesitate, it just does the math.
It's bleak, you know? Like, listening to you say that, if you're a listener trying to get into this space, it makes me realize how impossible it is to compete. If I'm sitting at home looking at a chart trying to decide if I should click buy, I am literally competing against a machine in Chicago that has already made the decision, bought it, and probably sold it before I even blinked.
Yeah. I mean, honestly,
Yeah.
you are. And that actually brings up the high-frequency trading stuff, HFT, because that's where the speed thing gets genuinely absurd.
Is HFT the thing where they print a servers right next to the exchange? I've seen documentaries about this.
Yes, co-location. Prop firms will literally pay millions of dollars to rent server rack space in the exact same physical building as the exchange's matching engine.
Just to shorten the physical cable.
Literally just to shorten the cable. Because fiber optic data takes time to travel. It's physics. If your server is in New Jersey and the exchange is in New Jersey, you beat the guy whose server is in New York by, like, a microsecond?
A microsecond. We're
Yeah.
talking about microseconds.
Yes. And they go even crazier than that. They build microwave towers between Chicago and New York because microwaves travel through the air slightly faster than light travels through a glass fiber optic cable. They spend hundreds of millions of dollars to shave off fractions of a millisecond.
Just to be first in line.
Exactly. And they use that speed for stuff like market making, where they act as the source calls it a digital shopkeeper. So they're constantly buying at the bid price and selling at the ask price, just capturing that tiny, tiny difference, the spread.
So they're like ticket scalpers.
Sort of. They stand in the middle. If you want to buy a stock for $10, they sell it to you for $10.01. And if someone else wants to sell that stock, they buy it from them for $9.99.
Well,
They keep the 2 cents in the middle.
wait, but how long do they actually hold the stock?
Oh, HFT. They hold positions for mere seconds, sometimes milliseconds.
Wait, that's literally their business model.
Yeah, they don't care if Apple goes up or down over the next hour. They couldn't care less about the company's fundamentals. They just want to buy it and sell it a millisecond later to capture like a tenth of a penny. But they do it 10,000 times a minute.
That feels like a scam.
It's not a scam.
I'm not saying illegal, I'm saying it feels like one. You're front-running the entire market just because you have a faster microwave tower. How is that adding any actual value to the world? It's just a tax on normal people trying to invest.
Okay, but the industry argument, and I'm just telling you what the source material says, is that they are providing liquidity.
Providing liquidity, that is such a corporate defense.
I mean, it is, but it's technically true. If you want to sell your shares right now, you want someone there to buy them immediately, right? You don't want to wait an hour for a buyer to show up. The market maker is always there. they're taking the other side of your trade. And because there are a bunch of HFT firms competing with each other, the spread, that gap between the buying and selling price gets super tight. It actually saves retail traders money on fees.
No, I get the theory. I understand the textbook definition. But if they're making billions of dollars just by stepping in front of my order for a millisecond, they aren't providing a service. They're skimming. They're a toll booth on the highway.
But they take on inventory risk. Like if they buy your shares and then the market suddenly tanks in that exact millisecond, they lose money. It's not completely risk-free. If a news event hits while they're holding 1 million shares for a split second, they can get wiped out.
Come on. They have the fastest servers on the planet. They aren't losing that race. If the market tanks, their code knows it before my screen even refreshes. It's an invisible tax, and you cannot convince me otherwise. It's rigged.
Look, the ethics of it are messy. And I'm not saying you're wrong to feel that way. I'm just saying mechanically, it's how the plumbing of the stock market works right now. You don't have to like it, but if you're trying to understand prop firms, you have to know this is the environment.
Fine. I'll drop it, but I still think they're parasites. So, okay, if HFT is just a pure speed game where the guy with the most expensive cable wins, what else is there? Because surely not every algo is just a millisecond toll booth.
Right. Speed isn't the only way. There's also statistical arbitrage, stat arb.
Yeah.
And this is more about complex math than just pure hardware speed.
Okay, math I can kind of follow. Break it down.
So imagine you have two companies that are basically identical in the eyes of the market. Let's say Coke and Pepsi. Historically, their stock prices usually move in tandem. If the whole stock market goes up, they both go up. If global sugar prices drop, their costs go down, so they both go up. They're highly correlated.
Makes sense. They sell the exact same thing to the exact same people.
Exactly.
Yeah.
But let's say one random Tuesday morning, Coke stock shoots up by 2%, but Pepsi stock drops by 1%.
Yeah.
And there's no real news. Coke didn't invent a new flavor. Pepsi didn't have a scandal. It's just a random, chaotic market fluctuation. A statistical ARB algorithm spots that divergence instantly and says, okay, this is a statistical anomaly. It's going to mean revert.
Stop. Stop right there. Don't use mean reversion. Like, I know what that means. Plain English, please.
Right. Sorry. We get stuck in the jargon. Mean reversion just means things eventually return to their historical average, the mean. So if Coke and Pepsi are historically always priced similarly relative to each other, and suddenly they aren't, the math says they will snap back together eventually, like a rubber band. You stretched it, and physics says it has to snap back.
Okay, I like the rubber band thing. So what does the bot actually do when it sees the stretch?
It buys the one that dropped, so it buys the cheaper Pepsi shares, and at the exact same time, it short sells the one that went up, Coke.
Short selling meaning betting it goes down.
Right, so no matter what the overall economy does, as long as the gap between those two specific stocks closes back to normal, the algo makes money. If the whole stock market crashes the next day, Coke falls faster than Pepsi, and the gap closes. They win. If the market rockets, Pepsi climbs faster than Coke, and the gap closes. They win.
That actually sounds kind of brilliant. It's insulated.
Exactly. It's a pairs trade. And prop firms love this because it's market neutral. They don't care if the S&P 500 crashes or goes to the moon. They only care about the relationship between Coke and Pepsi.
Okay, so they just set that math up, plug it in, and print money forever. Why doesn't everyone just do that?
Because here is the darkest secret of algo trading. And this is honestly the most fascinating part of the whole source document to me. It's this concept called algorithm drift or strategy decay.
Decay, like it rots.
Yeah, literally. Because algorithmic strategies eventually destroy themselves by influencing the exact patterns they're designed to exploit.
Wait, I need you to explain that. How does a math equation destroy itself?
Okay, so think about the Coke and Pepsi rubber band. Let's say your firm figures out this perfect mathematical relationship. You start trading it. You make a bunch of money. But then your firm scales it up. The bosses say, this is working. Let's put $50 million behind the trade. Then $100 million.
Okay.
Oh, wait. The moment you start pumping that much actual money into the market, your own trades start moving the prices. Your algorithm buying Pepsi actually makes the price of Pepsi go up. Your algorithm shorting Coke makes Coke go down. You are forcing the rubber band to snap back faster just by participating.
Because you're creating the demand.
Yes.
Yeah.
You become the market impact.
Yeah.
And then it gets worse. Other prop firms notice the same anomaly because they have smart math guys too. So now 10 different algorithms from 10 different firms are all attacking that exact same Coke. And Pepsi spread the millisecond it opens up.
So everyone is pulling on the rubber band at the same time.
Yeah. It's a self-referential problem. Once a strategy becomes popular, or once it scales too big, it becomes the market. The inefficiency, that tiny little gap you were exploiting, gets squeezed out completely because everyone is trying to squeeze it. The edge disappears. The strategy literally eats itself.
But then why do prop firms even bother?
What do you mean?
If the strategies eat themselves, if you spend all this time and money building this genius mathematical algorithm, and the second it actually starts working really well and you put money in it, it destroys its own profitability. That sounds like a horrible business model.
Because it's an arms race. You don't build one algorithm and retire to a beach. You build 50.
Yeah.
You're constantly hunting for new tiny inefficiencies. Maybe today it's Coke and Pepsi. Tomorrow it's gold and the Australian dollar.
Right.
And while one strategy is decaying and rotting away, you're rolling out a new one. This is exactly why prop firms are so insanely cutthroat during the testing phases, the forward testing.
Forward testing, like
Yeah.
trying it out in live markets instead of past data.
Yeah, but with tiny amounts of money, because they know a strategy might only work for 3 months before the market adapts to it. It's a treadmill. You can never stop running. The moment you stop inventing new math, you die.
Okay, but this brings me to a huge problem I have with this whole industry. Like, if you're a listener thinking about trying to trade, this sounds hopeless.
Uh-oh, here we go.
No, seriously, think about what you just described. To even play this game, to even get on this treadmill, barrier to entry is impossible.
It's high, yeah.
No, you listed it in the notes. It's not just high. To build a reliable system, you need deep expertise in, what was it? Finance, math, statistics, computer science, and networking.
Yeah, 5 distinct disciplines.
Right, 5. So let's break that down. Why networking?
Because, think about it. You can have the best math, the best statistical model in the world, but if your actual server, if the hardware drops a data packet because your networking architecture is sloppy.
Like when my streaming service buffers.
Exactly. But if your trading server buffers for, 2 milliseconds, you just bought 10,000 shares of Apple at the wrong price because the price moved while you were buffering, you're dead. So you need a networking engineer who understands packet routing at a microscopic level.
Okay, and computer science is obvious. You have to code the thing. Math and stats to find the rubber band.
Yeah.
Finance to understand what Coke and Pepsi even are.
Right.
So you basically need a team of 5 different PhDs just to build a basic system that is probably going to eat itself in 3 months anyway.
I mean, at the institutional hedge fund level, yes. That's exactly what they have. Entire floors of PhDs.
So then explain to me why this entire retail prop firm industry exists. If it requires 5 PhDs to compete against servers that are physically cable tied to the NASDAQ, then prop firms offering these trading challenges to everyday people in their bedrooms, they're just harvesting evaluation fees. They are. They're saying, hey, pay us a fee, pass this little test on your laptop, and we'll fund you. But they know the retail trader is doomed. They know the guy in his bedroom doesn't have a microsecond microwave tower in Chicago and a team of statisticians. They're just collecting the upfront fees from people who are statistically guaranteed to fail. It's evaluation fee harvesting.
Okay, wait. I have to defend the industry a little bit here because that is not entirely fair. I mean, yes, if you are trying to build an HFT server from scratch in your garage to scalp pennies, you are going to lose, obviously. The big firms will crush you. But the landscape is actually blurring a lot.
Blurring how? Because math is math.
Well, look at the internal data we see. We look at transparency metrics all day long, right? The reputable firms, the ones with transparent rules, not the scammy ones hiding weird conditions in the fine print. They're actually democratizing the application of these algorithms.
Democratizing. I hate that word. It's always used to sell something.
Hear me out. I'm not saying it's easy, but you don't need a PhD in computer science and networking to use an algorithm anymore. Platforms like MT5.
What is MT5?
Oh, MetaTrader 5. It's basically a trading software platform. Think of it like Shopify, but for trading. You don't need to know how to code a secure checkout portal to sell t-shirts online, right? Shopify does the hard infrastructure for you. MT5 and similar tools do the infrastructure for retail traders. They allow you to plug in automated strategies without coding the network architecture yourself.
Okay, so the software handles the plumbing, but they're still plugging those strategies into a market dominated by the big guys with the microwave towers.
Yes, but they aren't competing on microseconds. Retail algo traders aren't doing HFT. They're doing trend following or swing trading algos, where holding times are hours or days. You don't need a co-located server to hold a trade for 2 days. If you're betting that the euro is going to slowly rise against the dollar over the next week, being 1 millisecond faster than Citadel doesn't matter.
Okay, I see the distinction. You're playing a different game, but you still need a strategy that actually works. And you just said the big guys squeeze out all the inefficiencies. So how does the bedroom trader find an edge?
Right, and look, I'll concede this to you. I'll admit it. Most retail algos fail. They do. It's a fact.
Thank you.
But they don't fail because a hedge fund has a faster server. They fail because retail traders overfit their backtesting data.
Overfit. What does that mean mechanically?
Yeah. So say you buy a trading bot online, or you build a simple one yourself. You have to test it before you use real money, right? So you download the last 5 years of market data, say 2018 to 2023, and you run your bot through that historical data to see how it would have performed.
Seems smart.
It is. But here's the trap. The bot loses money in the simulation. So you tweak the settings, you change the parameters. You say, okay, only buy on Tuesdays. Run it again. Still loses. Okay, only buy on Tuesdays if the price is above this specific line. Run it again. Hey, it made a profit. So you keep tweaking and twisting and adjusting the rules until the bot shows a massive, beautiful profit on that historical data.
Oh, I see. You're basically giving it the answers to the test.
Exactly. You optimized it perfectly for the past. You built a machine that is absolutely flawless at trading the year 2021. But the market today isn't the market from 2021. In 2021, everything was just going up. It was a massive bull market. So your bot just learned always buy, never sell.
And then you turn it on in 2022 and the market crashes.
And it instantly blows up your account. It buys the dip all the way down to zero. That's overfitting. You tailored the suit so perfectly to a mannequin that it doesn't fit a real moving person. That's not the prop firm scamming you with evaluation fees. That's just you doing bad math. That's why the good firms, they force you to trade in a simulated live environment first. To prove your system works now, in real time, not just in a perfectly tailored historical backtest.
Okay, I'll give you that. Overfitting makes total sense. People are basically lying to themselves with historical charts because they want to see the big profit numbers. I get that. But even if you avoid that, it still feels like walking through a minefield.
It is a minefield. Which is actually why the most important part of all of this, more than the complex math, more than the microwave towers, is risk management.
Ah, yes. Risk management. The vegetables of the trading world. Nobody wants to talk about it, but you have to eat it.
Literally the only thing that keeps these firms alive. Survival over profit. That is the mantra across the entire industry, from retail to Wall Street. You can have the most sophisticated multi-asset statistical arbitrage model in the world, and it's completely useless without hard-coded circuit breakers.
Circuit breakers. Like stopping it from trading if it loses too much.
Yeah. Drawdown controls, position limits. Because algorithms are okay. Fundamentally, algorithms are stupid.
I thought there were brilliant math geniuses that read news headlines.
They are brilliant at the one specific thing they were programmed to do. But they have zero common sense. If the market suddenly does something completely irrational, like a massive geopolitical event happens out of nowhere, or a central bank does a surprise rate cut at 2 a.m., the algorithm doesn't understand context. It just sees the data going crazy. And if it doesn't have a circuit breaker, it will just keep executing its logic, buying a crashing market all the way to zero in milliseconds.
Which is terrifying. It's like a car with the gas pedal stuck to the floor.
Exactly. So risk management is literally just putting an emergency brake in the car.
Yeah.
If an algo loses, say, 2% of its capital in an hour, a circuit breaker just cuts the cord. It unplugs the server. It shuts the system down and alerts a human.
Well, and this ties into something I noticed when you look at the landscape of retail prop firms. Because when you read the horror stories online, the biggest nightmares people talk about aren't even the markets crashing or a geopolitical event. It's the fine print of the prop firms themselves.
Oh, with T and C's.
Yeah.
The terms and conditions.
Right. Like you see firms hiding strict rules about holding trades over the weekend or these weird trailing drawdowns.
Trailing drawdowns are brutal.
Explain how that works because it sounded insane when I read it.
Okay, so a normal drawdown limit is simple. You start with 100 grand. The rule is you can't drop below 90,000. If you lose 10 grand, you're out. That's fair. But a trailing drawdown follows your highest balance. So if you make 10 grand in profit, your account is at 110. Your failure point moves up with you. Now, if you drop back to 100 grand, your starting balance, you fail.
So your limit to lose money shrinks as you make profit. You're punished for making money if you give any of it back.
Exactly. It's designed to make you fail. And that's why we harp on finding transparent firms. It feels like risk management for the retail trader isn't just about surviving the market, it's surviving the prop firm's own rulebook.
Honestly, that is a huge part of it, which is why the #1 piece of advice in the source material, and this applies whether you're a guy in his bedroom or a quant at a hedge fund, is start simple and iterate.
Start simple, meaning what? Don't try to trade Coke and Pepsi while also trading gold.
basically. It means start with a basic single instrument system. Just trade the S&P 500, just use one moving average. Don't try to build a complex multi-asset disaster with 50 indicators. Because, blunt truth, complex systems just find more creative ways to lose money during abnormal market conditions.
More creative ways to lose money. That is profound. I should get that on a t-shirt.
It's true. The more moving parts your code has, the more things can break when volatility spikes. Think about debugging. A simple system is easier to debug. When it loses, you look at the code and you know exactly what it lost. Oh, the price crossed this line, so it bought, but the trend reversed. Simple. But when a neural network with 1,000 parameters loses...
Wait, what makes a neural network different from a regular bot?
Oh, right. So a neural network learns on its own. It's AI. You don't tell it the rules, you just give it data and tell it to find patterns. So when it makes a bad trade and loses $1 million, you literally have no idea why it made the decision. It's a black box. You can't ask it. It just found some invisible pattern that turned out to be wrong.
Which brings us to the future of all this. Because the last part of the source material gets into AI and alternative data.
Yeah, that's where things are heading right now.
And I have to say, looking at how you described it, it fills me with a mix of dread and, well, mostly dread, but a little fascination. Like you mentioned AI reading news headlines earlier, but alternative data is way weirder than that, right?
Yeah, alternative data is anything outside of standard price and volume charts. It's data that wasn't originally meant for finance.
Give me an example of how they use it.
Okay, the classic example is satellite imagery of retail parking lots.
Wait, like looking at Walmarts from space?
Literally. So hedge funds buy real-time satellite photos of Walmart parking lots across the entire country. They feed those images into an AI neural network. The AI is trained to count the pixels that look like cars. It counts the number of cars parked outside Walmarts every single day.
You are kidding me.
I'm completely serious. The AI correlates the car count to historical data. It says, okay, there are 15% more cars in the lots this month than there were this time last year. Therefore, it predicts that Walmart's quarterly earnings report next week is going to blow past expectations.
So they buy the stock before the earnings report even comes out.
Exactly. They know Walmart had a good quarter before Walmart's own accountants know, because they counted the cars from space. They also use credit card receipt data, shipping container tracking, app download metrics, and AI is getting so good at crunching these massive, weird data sets to find correlations that humans couldn't possibly see.
So we're moving from algorithms executing trades super fast to AI predicting human behavior based on where we park our cars.
Pretty much. That's the edge now. Speed is maxed out. You can't go faster than the speed of light. So the new arms race is data processing. But the interesting part is the source material talks heavily about collaboration. Human and AI collaboration. It's not just replacing the trader completely. It's giving the trader an AI co-pilot.
How does that work? Does the AI just give suggestions?
Kind of. Imagine a human portfolio manager. They can only read, maybe 50 financial reports a week? An AI co-pilot can process the entire internet, read every SEC filing, count every car in every parking lot, and synthesize it all in real time. Then it flags the human and says, hey, look at this weird anomaly in the supply chain for semiconductor chips. And the human uses their intuition, their actual understanding of the real world, to decide if it's a good trade.
Okay, I guess that's slightly less dystopian.
Yeah.
Slightly. It puts the human back in the driver's seat just with a better dashboard.
Exactly. Well, look, we've basically talked our way through a massive amount of the mechanics here. I mean, we've covered a lot of ground.
We really have. My brain is a little fried, honestly. Satellite parking lots and microwave towers.
So what's the actual takeaway for you? Like, if you're talking to a listener who wanted to know if they should buy a trading bot, where are you at now?
I think, honestly, the biggest realization for me is that algorithms aren't magic money printers. They aren't these infallible, perfect machines. They're actually highly fragile. Like, they're incredibly fast and precise, but if the market context shifts even a little bit, or if they scale too much and start moving the market themselves, they just break down. They eat themselves.
Yeah, the algo drift thing is wild. The idea that success literally breeds failure in this specific industry.
It is. And it makes me realize that anyone selling a set-it-and-forget-it trading bot on social media is just lying. Because the market is literally designed to break these things over time. You can't set and forget something that decays.
Exactly. It's a constant treadmill. And for me, I think it just reinforces that risk management is literally the only thing that matters. It's the only thing keeping these firms and retail traders alive. The mass changes, the edge disappears, the strategy rots, But a hard stop loss is forever.
A hard stop loss is forever.
Beautiful. Right. Put that on the back of a t-shirt. Anyway, I think we're going to wrap it there because otherwise we'll just start arguing about whether market makers are a scam again.
Oh, I'm still right about that. There are taps on the system. You just learn to love the toll booth.
We're not doing this again. But actually, it leads right into the next topic. Next time, we are going to get into something closely related to this talk of. We're looking at an article about the blurring lines between prop firms and retail brokers, because that landscape is getting really messy, really fast. The infrastructure is colliding.
Looking forward to it. Though, honestly, my final thought on all this AI and bot stuff. Wait, I mean, if all these algorithms are just fighting each other in milliseconds and reacting to each other's fake orders and counting cars, are we even trading companies anymore? Or are we just watching a giant AI server farm playing an incredibly expensive closed-loop video game with the global economy? Because that is a terrifying thought.
That is, yeah, I'm going to be thinking about that tonight. That's a great question to end on. Awesome. Thanks for hanging out, and we'll catch you on the next deep dive. Keep your risk tight, and, try not to compete with a microwave tower.
Remember, if you're feeling a gut instinct about a trade, it's probably just cognitive bias from losing your last one. Let the math handle it, or at least double-check your charts. See you next time.